In this video, I will be revealing my investing plan for 2025 and also sharing the individual stocks which are currently on my watch list. So do make sure you stick around for the whole video to get the full benefit. My first investing plan for 2025 is not really part of my investing plan as such, but it is a plan to make more free video content on YouTube. So do make sure you like and are subscribed so you will be notified when I make a video. Also, only around 5% of my viewers are actually subscribed to my channel, so do make sure that you subscribe. If you've been following my channel, then you will know I mainly talk about ETFs. The majority of my portfolio is also in ETFs, which currently sits at around 55% of my total portfolio, if you don't consider my thematic ETFs, which I'm also invested in. The main ETFs I am currently invested in is IGDA, which is a world ETF, which I have covered many times on this channel, and the other ETF is ISWD, which is another world ETF but a bit more conservative. I've also recently added ISDE, which is an emerging markets ETF, as I believe it has more room to grow over the long term. This is over at least a 10-year time horizon. So these are all halal ETFs, which again I've covered on this channel, so do make sure you check those videos out to fully understand what they are all about. So currently these ETFs account for around 55% of my total portfolio. My plan for 2025 is to keep around the same allocation in my key ETFs. So this will be around 50 to 60% of my total portfolio. If it goes above this, then I really wouldn't mind, as I want the majority of my money invested in these halal ETFs. The main reason is because although I've been investing in stocks since 2020, I still feel more comfortable investing in ETFs as they are less risky and more stable. This whole method is known as the core and satellite approach of investing. Basically, the core and bulk of your portfolio is in ETFs, and the satellites are different investments outside of this. It's a common method used for individual investors who enjoy the hands-off experience of investing in ETFs, but also like researching and picking individual stocks. The other ETF I am invested in, which I didn't include as part of the original ETFs, is a thematic ETF. This is not a halal ETF, but it is considered permissible to invest in because the holdings are mostly compliant. This ETF is a semiconductor ETF. Ticker symbol is SMGB. I know the semiconductor industry is a booming industry, and I used to be invested in AMD and Nvidia back in 2021, but realized it's more stable to invest in an ETF, as individual companies in this sector are very volatile and unpredictable. This is around 10% of my total portfolio. I will also aim to be keeping this allocation the same. The rest of my portfolio will be in individual stocks. So my investing strategy is to invest in mainly dividend growth companies. These are basically companies that are growing but also paying dividends. The dividend yield will likely be low because the company is focusing on growth, but the dividend will grow over time as the company increases its dividend every year. There's a lot of comments for and against dividend companies, so investing in dividend stocks. I can do an in-depth analysis of both arguments, but overall I believe if you invest in undervalued dividend stocks with growth potential, it is a good place to start. I will also consider some growth companies which do not pay dividends, so my allocation is not very strict. So now you know the majority of my portfolio. I will go into the individual stocks that are on my watch list. Some of these stocks I may already own, but are on my watch list because I want to add more to them, in the sense that they are not a significant part of my portfolio, whereas others are not part of my portfolio. Please let me know in the comments if you would like a more in-depth analysis of any of the individual stocks Also, none of this is financial advice, so always make sure that you do your own research. So I've just jumped into my stock valuation spreadsheet to view the different companies on my watch list. And if you wanted access to this spreadsheet for yourself, just click the link in the description. I've made a video on how to use it, but it's basically a very useful tool where you can see sort of all the key information about a company in a snapshot, and you can also value the company using various different methods. So the main one is the discounted cash flow model, and then there's also the Benjamin Graham model, multiple model, and the dividend discount model. So you can come to a fair value that you should pay for the company. So I have made a video on that, so do check that video out if you are interested. So as you can see, the first company on this list is Adobe. Ticker symbol is ADBE. Adobe creates software solutions for digital creativity, marketing, and document management, including popular tools like Photoshop and Acrobat. So after having talked about dividend stocks, this company does not actually pay a dividend. This is more of a growth company, but I have included it in the list because I do believe at some point in the future that Adobe will start to pay a dividend, similarly to how other growth companies have, like Google and Salesforce. Recently they've started to pay a dividend. What I really like about Adobe is their financials. It's in a very healthy position, and if we look at their revenue over the past 5 years, they've grown over 14%, so it shows that they are able to increase their market share, and their profit margin is fairly healthy as it's over 20%. And even looking at their key metrics, they look quite healthy. So if we look at their price to earnings ratio, it's 35. So although I do like to see 20 usually, it's usually not the case for tech companies and software companies, so they're usually quite high. And if I compare this with a company like, for example, Salesforce, we can see that the PE ratio is a lot higher. And then if we look at their current ratio, it's well above 1. This means that the company has more assets than it has liabilities, which is obviously always a good position to be in. The long-term debt to equity is low, and the price to free cash flow is around 30. So I do like to usually see this around 20, but 30 isn't overly high either. Obviously, we would have to do a discounted cash flow valuation to really see if it's fairly valued. But for this purpose, we can see it's around 30. And then all of these sort of return on assets are in the double digits. So you've got double digits return on assets, return on equity, and return on investment. So these are really good financial metrics. And if we look at it from a technical perspective, we can see that the company is down over 30% from its 52-week high. So that's usually a good position to be starting to look at a company, because it can mean that it's potentially oversold and potentially undervalued. So this could be a good opportunity, but obviously you would have to sort of research the company first and then do a sort of valuation. And the beta is above 1, so usually 1 would represent the market, and anything above 1 means it's more volatile than the market. So this is 1.3. Because it is a growth company as well, it is expected to be more volatile than the market. And if we look at a snapshot of their earnings, we can see that their revenue quarter on quarter has increased over 11%, and their earnings per share has increased quarter on quarter over 17%. So as I mentioned earlier, the technicals have dropped, but it seems like the earnings are increasing. So again, that's usually a good sign to start looking into a company, because if the company is performing better but the share price is dropping, then again that usually means that the company can potentially be undervalued, or it should at least be considered to be looked into. And as you can see, the year to date it's dropped 25%. But if we go up here, we can see the analyst ratings. So they currently have this as a hold. So even though they have it as a hold, they have a price target of 590. So they would sort of say it's around fair value. But analysts don't always get it right, and sometimes they do suffer from recency bias. So the best thing to really do is value the company for yourself using your own assumptions. And again, I have made a video on how to use this spreadsheet for yourself. So do check that video out if you are interested in this spreadsheet. One of the main risks for Adobe, as with any other company, is their competition. One company I'm familiar with and actually use for my fancy thumbnails is Canva. But we have seen that Adobe has been able to increase its revenue and maintain its market share at the moment despite competition. However, more recently, with the growth of AI, more companies are becoming more competitive in this industry. An opportunity is that Adobe has strong recurring revenue from a subscription-based business model. The next company on my watch list is Visa, and the ticker symbol is V. Visa is basically an electronic payments company. They provide a global network for secure and fast transactions between consumers, merchants, and banks. Although they are a finance company, they don't deal with interest or loans. We can see that their revenue has grown over the past 5 years, just over 10%. And what's really impressive is their profit margin at over 54%. This means the company can easily control costs in market downturns. Their key metrics look very healthy as well. The company also pays a dividend, so although the payout is low, they are more focused on growth. And here you have their earnings information, which has been very impressive quarter over quarter. One of the risks for this company is their recent issues with the Department of Justice. But this to me just proves how powerful the company is. An opportunity is that the company has predictable revenue. As long as people are using their Visa cards for transactions, Visa is always benefiting. The next company on my watch list is Hershey's. This is a chocolate and snacks company with many well-known brands. Their financial and key metrics look decent. It has a low PE and price to free cash flow, which could mean that it is undervalued, but you will need to find out from doing the valuations. Also, it could be valued low because of the risks associated with the company. Analysts also have this as a sell. From a technical perspective, it's over 20% down from its 52-week high, so another company that's been oversold. It also pays out a decent dividend with good growth history. Their earnings, however, have shown a decline year over year. The biggest risk with this company, I would say, is the cocoa prices. They have shot up recently, and obviously being a chocolate company, this will be their main ingredient. Therefore, they will have to increase prices of its products. An opportunity is that it has a good track record of dividends and financial growth. The next company on my watch list is S&P Global. They provide financial information, analytics, and credit ratings to support decision-making in global markets. They have shown revenue growth over the past 5 years and have a decent profit margin. Their key metrics are also decent. Analysts have rated them as a hold. They pay a small dividend with consistent growth over time. Their earnings are also impressive. One of the main risks of this company is regulation risks. An opportunity is that it currently has a strong market position with recurring revenue. The next company is Pool Corporation. They are the world's largest distributor of swimming pool supplies, equipment, and related outdoor living products. What's really attracted me to them is that they were recently purchased by Warren Buffett, who is obviously a very popular and successful investor. And having briefly looked at their financials, they look like a decent company. One of the main risks is the seasonality of pools. Obviously, they will not be in as high demand in winter. An opportunity is that they are currently the market leader in this industry. The next company is Tenaris. They are the leading global manufacturer and supplier of steel pipes and related services for the energy and industrial sectors. This is not a popular stock and there's not much content relating to it online, but having looked at their financials and key metrics, it looks very impressive. Their revenue has grown considerably over the past 5 years. They also have a healthy profit margin. Looking at their key metrics, their PE ratio is low and their current ratio is very impressive at 3.65. Their long-term debt to equity is also really low and it's basically non-existent. Their price to free cash flow suggests it's undervalued but would obviously need to be properly valued, and their return on assets, equity and investment are all in the double digits. They also pay a decent dividend. One of the main risks is the seasonality of the industry. Energy companies are very cyclical. An opportunity is that it has a strong position in the energy sector. The next company is Uber. This is another company that doesn't pay a dividend as it is currently focused on growth and they have recently turned profitable. Analysts have this as a buy. I believe that's the only buy rating from the list of stocks that I've covered. Their financials and key metrics look impressive. So that was a quick video of my investing plan for 2025 and some of the companies on my watch list. As mentioned, I do already own some of the companies, but they are still on my watch list as I hope to buy more if there are any decent dips. This was just an overview of the companies. If you was interested in any of them, then do make sure that you do your own research and really analyze the companies. Let me know if you would like a more in-depth analysis of any of the companies. Also, what companies are on your watch list? Do let me know in the comments below.